If you have cash sitting in a savings account earning 0.38%, here is something most people do not realize. You are losing purchasing power every single day while banks pay you practically nothing. Today I am going to show you how to lock in 4.5% guaranteed returns with zero risk using a CD ladder, and why the window to do it may be closing. Before the numbers, here is the lens. Annualize every income claim. Multiply the rate by your principal to get real dollars per year. Then compare it to the national savings average of 0.38%. A 4.5% CD is not just a bigger number. On $10,000, it is $450 a year instead of $38. That is the lens. Every number in this video gets read through it. Let us start with where rates stand right now. The top nationally available CD rate is 4.5%. That is at Popular Direct and Bread Savings across multiple terms. E-Trade offers 4.4% on a 1-year. CFG Bank hits 4.15% on 6 months. These are real, FDIC insured, and available today. Now the context. The national average savings rate is 0.38%. The average 1-year CD nationally is 2.03%. The best offers are more than double that. 3 Fed rate cuts in late 2025 pushed CD rates down early this year. But something changed this summer. In May, nearly 24 banks raised CD rates. In June, about 35 did. In July, about 60 banks increased rates. That is a clear reversal. The reason is uncertainty. The Fed has held steady all year. Inflation remains sticky. Tariffs and geopolitical tension add more unknowns. Banks are pricing in the chance that the Fed might actually raise rates later this year. When banks expect higher rates ahead, they compete harder for deposits now. That is why you are seeing 4.5% offers in August. A CD ladder solves the main problem with CDs. If you lock everything in a 5-year CD at 4.5% and rates jump next year, you are stuck. If you keep it all in a 1-year CD and rates fall, you lose. The ladder splits your money across maturities. Equal amounts in 1, 2, 3, 4, and 5-year CDs. Each year, one rung matures. You reinvest it at the new 5-year rate. You capture the average of the yield curve. You always have money coming due. You never lock everything at the bottom. Here is what this looks like in dollars. $50,000 in savings at 0.38% earns $190 a year. The same $50,000 in a 5-year CD at 4.5% earns $2,250 a year. That is $2,060 more every single year. A ladder earns about $2,235 a year and keeps one rung liquid. Over 5 years, the ladder captures rising rates. The lump sum locks you in. The savings account loses to inflation either way. Before the bank signals, compare CDs to the alternatives. A 6-month treasury pays around 4.3% and is exempt from state and local taxes. But you have to manage the auction calendar yourself. Money market funds pay about 4.2% today. Easy and liquid, but the rate floats and will drop the moment the Fed cuts. A bond exchange traded fund pays a similar yield, but its price moves with rates. Rates rise, your bond fund loses value. A CD does not do that. The value never drops and the rate is locked. The trade-off is simple. CDs give up instant flexibility in exchange for a guaranteed rate. For money you will not touch for a year or more, that trade is usually worth it. Now the rate signal. I ran 3 bank stocks through KRONOS, the prediction model this channel is built on. First, JPMORGAN Chase, the largest U.S. bank by deposits. KRONOS sees it at $363 today, falling to $290 by the end of the 30-day forecast. That is almost 20% downside. The confidence band runs from 289 to 368. A bearish signal for the biggest bank in the country. Second, Bank of America, the most consumer deposit heavy of the 3. KRONOS sees it at $64 today, dropping to $49 in 30 days. That is nearly 23% downside. The confidence band runs from $48 to $65. The model is calling a steep decline for a bank whose funding is almost all deposits. Third, Wells Fargo, still rebuilding its deposit base. KRONOS sees it at $88 today, falling to $75. That is 14% downside. The confidence band runs from $74 to $89. All 3 banks point the same direction. The market is pricing in weaker credit and possibly higher rates ahead. This is not a stock recommendation. It is a rate signal. When KRONOS turns bearish on the three largest consumer banks at once, it is telling you the market expects rising funding costs and weaker credit. Bank stocks are priced for higher rates. That means CD offers may stay elevated. The banks need your deposits, and they will pay to get them. The 4.5% window is not closing yet, but it will close the moment the Fed signals cuts. Watch these bank forecasts. They are the market telling you which way rates lean. 3 things to watch. Early withdrawal penalties. On a 5-year CD at Popular Direct, the penalty is 730 days of simple interest. That can eat into principal. FDIC limits. $250,000 per depositor per bank. If you have more, spread it across institutions. Taxes. CD interest is taxed as ordinary income. A 4.5% CD at 37% federal tax becomes 2.84% after tax. Still beats savings, but the gap narrows. Consider holding CDs in an IRA if you have room. For mistakes quietly destroy a CD ladder. Mistake 1. Breaking the ladder for spending. The point of a maturing rung is reinvestment, not a shopping trip. If you spend the matured $10,000 every year, you are slowly cashing out. Mistake 2. Ignoring the penalty on the early rungs. If you need the money in 6 months, a 5-year CD is the wrong rung no matter what it pays. The 730-day penalty erases almost 2 years of interest. Mistake 3. Chasing a slightly higher rate at a bank you do not trust. A 4.50 versus a 4.40 difference on $10,000 is $10 a year. Not worth the risk. Stick with FDIC-insured institutions. Mistake 4. Forgetting to reinvest. Banks roll your matured CD into a default account paying near zero unless you act. A ladder only works if you actually reinvest each rung. For mistakes, all avoidable. Here's what to do. First, check your emergency fund. Keep 3 to 6 months in a high-yield savings for instant access. Everything above that can ladder. Second, pick 2 or 3 banks from the top offers. Popular Direct for 5 years at 4.50. E-Trade for 1 year at 4.40. Third, split your ladder money equally across the rungs. 20% per rung across 5 maturities. Fourth, set a calendar reminder for each maturity date. When a rung comes due, reinvest at the new 5-year rate. Fifth, watch the Federal. If they signal cuts in September, the 4.5% offers may vanish. The window is open today. It may not be next month. CD rates at 4.5% will not last forever. The data says the window is narrowing. If you have cash earning 0.38%, every week you wait costs you real money. Build your ladder this week. Lock in the rate. Let the math work for you. Timestamps and charts are in the description. Thanks for watching. This video is for educational and entertainment purposes only. It is not financial advice. Past performance does not guarantee future results. Always do your own research and consult a qualified financial advisor.